How can a 1031 exchange help defer taxes when selling real estate?
Yeah, so a 1031 deferral is a like-kind exchange. This only applies to investment real estate, does not apply to your personal home. You can't live in it before or after, basically, this whichever property it is. For investment real estate, you have something that has a lot of gain built into it. I bought that house for 100 grand 20 years ago, now I'm selling it for 150. Great. I don't want to pay the tax on it. And so if I'm going to keep that money invested in the real estate market, then instead of taking the money from my personal lifestyle, I can roll it over into the next property. And if I do that, then the gain is deferred. So it's tax free until I sell that second property. The way it works is you get a 1031 intermediary. You can't just decide to do this yourself. You have to have a third party hold the money for you and do the transaction. So you get a 1031 intermediary, and you sell property number one. The money goes to the intermediary, and then you have basically three months to find the next property and another 3 months to close all the property. And you say, okay, the money you're holding for me, I want to spend on this property. And 1031 says, great, give me the lawyers or closing agents information, and they handle all the flow of the funds. So as long as you roll over the entire amount, then it's totally tax-free to you. If you and it doesn't have to be 100%. You can shave it any way you want. You can do full rollover, you can do a partial and pay tax on the amount that you take and all this kind of stuff. You can totally up to you. Now, caveats with this is that this basically only works if you are buying something that is more expensive. You'll have to step up your way through the investment world, which is okay. And you can do it with, it doesn't have to be 1 to 1. It could be 1 to 3, it could be 1 to 5, it could be 1 to whatever, just depending on how the sales proceeds work for you. So the thing to keep in mind though is that your basis for the next property remains the same as the property you sold. So if I bought the place for 100 grand 20 years ago and I'm buying the new place for 500 grand, my cost basis for when I sell that second property is the 100 grand on the first property. And that's a lot of people get confused by that because that when they go to sell that second property, they say, I bought it for 500 and now it's worth 600. That's $100,000 for the gains. So no, you did a 1031. You bought it for 100 and you sold it for 600. So now you have a $500,000 gain. And on the end of the cycle, people will roll over their money over and over again. And then they have this big portfolio if things went well, and their cost basis is effectively zero. And so they're like, people start to feel trapped and they start to say, if I sell now, I've got a huge tax problem. Well, not a problem, I've got a huge tax bill. And I don't know if I really want to do that. And some people overextend themselves with financing and they actually don't have the cash to pay the taxes. That's a nightmare scenario that you don't want to be in. So the traditional plan is you do 1031s, you roll over, grow your real estate empire, and then you die. And your heirs pick up the property at the current market value for their basis. So the tax bill never comes as long as you die with the property. If you want to cash out, then the tax bill gets hit. So just things to be aware of when you're building your 1031 empire. Sometimes people reach 60, 70, and they're like, I don't really want to do this anymore. Well, you might have more trouble getting out than you expected.
Yeah. Yeah, that would be a long time, right? Especially if they started like in their 20s.
Yeah, it does
Uh,
happen though.
yeah, crazy. So we have a retiree question.
Okay.
Someone wants to know, are there tax benefits to moving to a retirement-friendly state?
Yeah. For sure. When people think about retirement states, they think about the state has no income tax, then that's going to be helpful. So federally, there's no, but the different states definitely have different rules. So if you go to a tax-free state, that's obviously going to be less tax taken out than wherever you're coming from. So a lot of we see a lot of people. So I used to work in South Florida. We saw a lot of people from New York, New Jersey, who were getting pension payments from like teachers and firefighters and police and all this kind of stuff. They have very generous pension programs. And then they move to Florida where there's no state income tax. It's like, oh, you're saving 10% on your maybe not 10, but whatever. You're saving a good chunk on your pension payouts. And there have actually been, I don't know, announcements by mayors' offices and governors and people from New York, New Jersey saying that this is unfair because that money was supposed to be taxed in New York, New Jersey to go back into the system for the current people. So the people who worked there all their lives, paid in, and are now getting benefits and take off, they're not continuing the cycle, and that's a major budgetary problem for them. So yeah, a lot of people do that. Now, just because your state has state income tax, a lot of states make allowances for retirement income. So Maryland, I think your first 30 grand, if I remember right, of retirement type income is tax free for state purposes. Georgia's pretty generous as far as their retirement benefits. You don't necessarily have to go to a tax free state in order to get tax benefits for retirement income. And you can look on the lists, all these publications will compile lists of cost of living in retirement, and they'll rank different places. And I would say consult those because there's a lot that goes into it, right? There's weather, there's tax load, there's access to healthcare facilities, there's social groups, all these kind of things. And don't make a decision just based on the taxes, but that should be part of your overall decision as far as what you want to do in retirement. But yeah, or build the real estate empire. It doesn't matter where you're, right? As long as you have cash flow
Great.
coming in.
It looks like we have a charitable giving question.
All right. This will be the last one for today. But yeah,
Okay. All righty. So a client wants to know what's the smartest way to give to charity and maximize my tax deductions?
that's a good question. And I hate to say it depends, but
It depends.
most people are not able to use charitable contributions anymore. So this was a change that came from the Tax Gun Jobs Act, which is Trump's tax reform back in 2017. And what happened there was that in before the 17 reform, you had exemptions, which was a deduction based on your family size. So it was like $4,000 a person, let's say. And then you had a standard deduction, and that was based on whether you were single, head of household, or married. And the standard deduction was a reasonable amount. So basically, if you had a mortgage and property taxes, then basically you itemized and you exceeded the standard deduction. And then in that scenario, any charitable contribution you made was increasing your already itemized deductions, and you were able to get full deduction for that amount. And that lowered your taxable income and that lowered your taxes, which worked great. 17 rolls around, Tax Cut and Jobs Act comes in, they got rid of exemptions and they doubled the standard deductions. So if you had a big family, you were actually hurt by the change. If you had a small family, you were helped. So under the standard deduction, so like this year, 2025, if you're a married filing joint couple, your standard deduction is $30,000. In order to get the benefit of charitable contributions, you have to exceed all your itemized deductions together have to exceed $30,000 before they start changing your tax bill at all. You can do that if you have enormous medical expenses, or you have an enormously expensive mortgage, or you give a whole lot of money to charity, and or you have some combination of that, right? So for most people, that is no longer doable, right? So the vast majority of people these days, you just use the standard deduction. So like I was talking to that same couple we talked about this the other day. So they were in, and so they were asking that same questions. What if we gave money to charity? Us, and we looked at their tax returns and says, well, you don't have a mortgage, you do have property taxes, and your medical expenses aren't that high. Basically, you would have to give $20,000 to charity before it started shifting your tax bill at all. And for most people, that's just a non-starter. If you have very high income and you give like a full 10% tithe, that kind of thing, then you might reach that. I've seen people give six figures to charity for sure. And in that case, yeah, it'll help. But for the majority, this doesn't do much these days. Where it can help for the retired people, like we talked about earlier, is the QCD, qualified charitable distribution. That can help directly because of the same standard deduction issue. But if you're not in that situation, you're not over 70, then unless you're giving huge amounts, probably not going to make a difference. But always run the numbers. Like whenever we're doing a tax return, we'll always calculate whatever the itemized would be, and we'll take the itemized if it makes sense, but usually doesn't. So that is how to take advantage of charitable. Now, I will say, if you're a high income earner, there are, again, like we talked about earlier, there are these companies out there that will create charitable deductions for you. So that is a potential option, but that's six-figure deals, so not applicable to most people. Okay, so that brings us pretty close to the hour, and that's all my it depends for now. I have one last it depends.